Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for July 5th of 2022. Please see your disclaimer for important information. Well, as we get started this week, obviously we're coming off a very difficult first half in the investment markets, the worst first half performance in the equity market since 1970, if that gives you any sense of the gravity of the situation. And so equity market returns were very weak. And in fact, peak to trough, we saw a 20% decline in the S&P 500. Now, fixed income, unfortunately, did not fare well at all either. And this is very unusual. And I wanted to start off the chart pack this week with this chart from Charlie Bolello. It shows you in rank from 1 to 10 the worst first half performances for a kind of a traditional 60-40 portfolio. And what do I mean by that? 60% equity, 40% fixed income portfolios are kind of used in the financial planning world as kind of a benchmark growth portfolio. In this case, the equity is represented by the S&P 500 index, and the fixed income side of that is represented by the Bloomberg U.S. Aggregate Index. And you can see for the first half of this year, that portfolio was down 16.1%. It's an amazing development, and obviously it proved to be perhaps one of the most challenging environments for traditional investment managers than that we've seen in a long time, because usually you get diversification from a fixed income portfolio that helps to soften the blow of a weak equity market. Well, in this case, both of those were down by a fairly meaningful basis. And so, if your returns for the first half of the year were negative 10, 11%, you consider yourself extremely fortunate. And because those returns, certainly held up better than the fixed income markets did on their own right, which were down over 10%. And then certainly much better than an equity portfolio, which was down as I mentioned, over 20%. And some elements of the equity market were down a lot more than that. Well, continuing with the theme, I wanted to show you yet another chart from Charlie Bolello, which shows basically from 1977 to 2022, returns in the market for stocks as well as bonds and some of these key years, and then kind of highlight some of these years in which we had really adverse equity markets. And you can see here that traditionally, you go from 1977, 81, 90, all the way down to 2008, that you actually had positive performance in this Bloomberg U.S. Aggregate Index. And so, like I said, in the last slide, equity markets were down 20% year to date for the first 2 quarters of 2022. Fixed income was down over 10%. And so that traditional 60-40 portfolio, which we just talked about, is down 16.1%. You can see that, in these other instances, equity markets, the 60-40 portfolio was still down, but that you got a meaningful cushion from fixed income, and so that the overall impact was not nearly as negative. Certainly not the case this year. Well, as we kind of continue this discussion of fixed income and the lack of diversification opportunities in the first half of the year to cushion the blow of the equity market, you can see here just how rare this occasion was for fixed income. You can see, all of these years going back to 1977, and with very rare exception, did you actually have a negative return in the fixed income market. And again, that is exceptionally rare. Now, we had that last year in 2021, slightly negative, but obviously people didn't pay as much attention to it because we had a relatively decent year in the equity market. Well, you can see that if you got to go all the way back to 1994 to find a negative return for the first half of the year, frankly, for the entire year, I should say, in the fixed income markets. And that was negative 2.9 for the entirety of 1994. And that represented the beginning of a rate tightening cycle by the Fed, if many of you might recall. So obviously we had negative returns slightly in 1999, and then we had a negative 2% print for fixed income returns in 2013. But just again, look at the gravity of the year-to-date number in fixed income, negative 10.4, and you can see how much of an outlier that is when you look at these annual returns going back many decades. Well, getting back over to the equity market, you can look at the returns here by various sectors and by style and factor returns over the last month. And so, when you look at this, the equity markets were down 8%, a little bit more than that for the month of June. And you can see that really there was no area of the market that was untouched in terms of, they all provided negative returns. Energy reversed a lot of its gain from earlier in the year. You can see materials, financials, discretionary continues to be weak. The areas of the market that did well from a sector standpoint, healthcare and utilities, and consumer staples, kind of essential spending areas, if you will. Real estate, industrials, again, we're negative, not quite as negative as the market as a whole. You can see there depicted in that blue line. But if you slide over to factor returns, and this is also kind of interesting too. So, value and growth were equally negative. So you didn't really have any benefit from either side of that. Momentum was no better than value, in fact. And then, if you look at the worst performance, the high beta, stock buyback, which is very interesting. Those companies performed overall worse in the market, and ironically, quality underperformed. And so we've emphasized both quality and dividends, and now on the flip side, dividend payers and those so-called dividend aristocrats actually performed relatively better than the market did, although they were still down. So low volatility and dividends were the best performers in the market. But when you go from growth to value to momentum, equal weighted in quality, all of those did not perform very well during the quarter. If you look at attribution for the negative performance that we saw in the first half in the S&P 500, you can see here very clearly that we had a significant amount of multiple contraction. And so that obviously impacted total return. We did have positive earnings, although you can see that the kind of the 12-month earnings per share consensus number has been coming down. We expect that to continue to come down somewhat. So, from an attribution standpoint, that was an offset because we did have earnings growth year over year to help us. But that was offset by significant multiple contraction, which is actually very common when you have higher inflation and interest rates which are going up. Now, we had a little bit of benefit from dividends, and you'll always have that. The dividends are never going to be a negative influence on returns. But clearly the biggest deal here is multiple contraction. Now we'll take a quick peek at credit asset returns for the month of June. And you can see here that all of these categories are negative by some degree. The better relative performance, I should say, obviously a treasury bond, as we saw. The 7 to 10 year treasury, we saw rates come down just a little bit after peaking, but they remain relatively high. And then if you want to find other relative outperformers, if you will, commercial mortgage-backed securities, residential mortgage-backed securities, and even high-yield municipals, as well as investment-grade municipals, both from a relative standpoint did certainly a lot better than business development companies, high-yield corporate, emerging markets, and sovereign debt. And then the other area of the market which received a lot of publicity over the last several months was the preferred market, and that market was down about 5% for the month. And so preferreds, when you think about the most exposed area in a market, most of these preferreds are perpetual maturities. which means that they're extremely long duration. And when you think about duration, the longer the duration, the more price sensitivity you have. And the same goes for BDCs, business development companies that have very long duration assets within their own portfolios. And so really the most price sensitive areas performed as you would expect them to, and they were very weak during this particular period. Now we have a bit of an attribution chart here for the Treasury market. And so what you see here on the left-hand side is essentially the attribution of Treasury yield changes when you when you look just at the second quarter. On the right-hand side, it represents essentially the year-to-date. And so the diamond blue dots that you see here are the aggregate changes in Treasury yields at these various maturities that you see on this chart. And then really the attribution is an offset between inflation expectations and the impact on real rates. And so when you look at this, particularly in the year to date, you can see obviously a tremendous amount of Treasury yield change in the aggregate. 10-year rates are up 1.5%. Short-term rates are up more than that because obviously the Fed is raising rates at a fairly aggressive clip. And so you've seen a bit of flattening in this in the yield curve, but you see really the impact here is from real rates. And essentially if you're the Fed and you're watching this, an increase in real yields, real rates, is really kind of a harbinger of a slower growth environment. And so I think this is something, honestly, that the Fed has been trying to manufacture. The market's helping them along with it, but it's something that they're trying to see, that they're actually trying to envision here is those higher real rates. This chart shows the relationship between the S&P 500 and the Barclays high yield credit spread indicator. And the credit spreads are in that lighter colored line there, and it's inverted to kind of show the relationship with the S&P 500. And so kind of intuitively speaking, when the equity markets are going down, it tends to indicate more overall economic stress in the market. And if you have greater economic stress, typically you have higher credit spreads because then there's an increased risk of default for high yield bonds. And so typically that relationship, when you invert the high yield credit spreads, is pretty positive. Now we have seen some notable divergence since about the second quarter of last year. And that has persisted, even though equity markets, just in terms of their degradation over this year so far, have kind of caught up with credit spreads. And so, a couple things you could infer from this is that, you might be close to a landing spot. We might be getting a little bit closer to, an inflection point in the markets. But, and the other way to read it too is that perhaps credit spreads have further to rise before they begin to settle out a little bit more. Well, I'm a little bit excited at this chart just because of the predictive power of it from JP Morgan Asset Management. It shows you consumer sentiment, which is, of course, extremely weak. We know that the consumer sentiment number is highly, highly sensitive to inflation data. And so with inflation being high, we know that the sentiment has been terrible. Absolutely terrible. But looking at that and then kind of overlaying data that we have in our possession on subsequent 12-month S&P 500 returns tells a really, really interesting story here. So when you have had these troughs, and this data series goes back to 1970 basically, and so you see and scrolling from left to right here in 1975, we had a trough in sentiment. That was obviously after OPEC. We were exhibiting meaningful commodity-related and energy-related inflation. And so when we reached that trough, the equity markets were up about 22% over the next 12 months. In May of 1980, again, another high inflation period. We had a trough in sentiment. And, the next 12 months following that trough, market was up 20%. 1990, this is in the wake of the Gulf War, and we had a mild recession. Again, the first three of these data points all tied to recessions. Market was up 29%. And then you get to March 2003, market was strong. October 2005, up 14.2%. November 2008, global financial crisis. That was an interim trough there, and the markets were still up 22% over the next year. August 2011, 15%, and then April of 2020, obviously with the shutdown, we know what happened during that. We had a very strong environment. So I mentioned these data points, and I'm spending a little bit more time on this slide really to underscore that there is an exceptionally strong relationship. There's never been a trough here in consumer sentiment that hasn't led to a strong equity market. Here's our S&P 500 stock price index on a 3-year moving average, and we're at a really interesting point here. So again, when you look at that dotted line, this is from BKA research out of Montreal, and you look down below at the lower end of the slide, it's the equity capitulation indicator. And so where we have seen inflection points in our market, and you look at that line and look at the encircled areas, those reflect inflection points that tie directly to what I'll call like peaks in capitulation. And so there's a very strong relationship here, and this market has rolled over and is in jeopardy of kind of breaking through this 3-year moving average. But we're also at a point of essentially a point of capitulation if you do a line of best fit that goes back to 2010. And so from that standpoint, from a technical standpoint, markets are really poised to settle out here if you're convinced that we're not due for some really bad, unforeseen data out in the economy. Now here's a look at our Treasury yield, and so this is dating essentially for the last month, dating back to the beginning of last month, i.e. June. And you can see the trajectory of the 10-year yield over that time frame. So we started below 3%. We hit a peak of around 350, and then we've backed down quite a bit. Now the market this is the market pricing in the increased probability of recession and slower growth. And so ironically, we ended the month not too far off where we started it. But what you can see here on the right-hand side is that the 2-year to 10-year government bond spread. And so this is essentially taking a 10-year yield and subtracting the 2-year from it. And so when you get a negative number in that calculation, that's what they call an inverted yield curve. And so, the bond market here, when we started in April and May and then June, we were very, very flat on the curve, and we're essentially, like I said, about where we started the month. And so we're really flat. There's not much difference in yields between the 2 and the 10-year Treasury. And again, the market is pricing in this slow growth time frame that anticipated on the horizon. They're pricing in a fairly weak environment, and I think again, if the Fed comes in and raises rates by 75 basis points, which I'm fairly certain they will do. In fact, I think there's a scenario where they raise it a full percentage point. And demand and growth slow, hiring intention slow, as we know they already are. Inflation expectations are already coming down, and if things begin to slow, I think the market can find its footing, because we'll have a little bit more visibility on things. And this is essentially your fixed income market pricing in the uncertainty and the risk of a slow growth environment. Here's nominal yields and inflation expectations. And so, what we see here is your 10-year note. Obviously, it's come off of its peak, and as I mentioned, it peaked at 3.5%. And so what you see is the TIPS break even, the Treasury inflation protected securities, and then the 5 and 5 break even, which is a 10-year outlook on inflation. And so that is actually very useful when you think about 10-year yields, right? Because you've got 10-year notes with a 10-year inflation outlook. And so what you see here is that those rates, those yields have come down a little bit, as we see here, and we also saw in the last chart. But it's being driven quite a bit by inflation expectations coming down, both from a TIPS pricing standpoint as well as a 5 over 5 number as well. And that 5 over 5 is essentially the 5-year inflation forecast 5 years from now. Here's our high frequency data, and you can see here that TSA checkpoint data, very strong. Supply of motor gasoline, supplies are tight, prices are high. We'll talk about gas prices here in a second. Global commercial flights are up both in the week and the month, and we certainly know in the financial press that the airlines are very much struggling right now to maintain their capacity, and there's a lot of displaced flyers out there with canceled flights and all sorts of problems logistically in this area right now. But and a lot of it is driven by the fact that, especially you look at that TSA checkpoint data being up almost 6% over the last month, that'll tell you what you need to know. Now, if you look at other areas like manufacturing, and I do think that we're close to a manufacturing recession, you see steel production down a little bit. You see rail car traffic down. And then the other areas, obviously, we know that the labor market continues to be exceptionally tight. Here's a quick look at real personal spending. We did have a negative print. It was expected to be down for the month of May, which is the last data point that we have, but it was actually down slightly more than that. You can see on that line of best fit below in the lower left, the real personal spending in aggregate is falling below that trend line a little bit. And so we knew that personal spending was dropping off. We see it in the data. When you back out, gasoline and food, you can clearly see that kind of the discretionary components are slowing down a little bit. And you can see on the right-hand side of this chart, the breakdown of real consumer spending. And you can see in the black line where you have durable goods, that's been very lackluster to down lately, as well as that blue line, which is the non-durable goods side. So, if you take goods in bulk, we know that is slowing down, and you're essentially seeing a flat line in total consumer spending, if not slightly, if you look at it over a kind of a longer term time frame. Here's real personal income, and you've got on the left-hand side that number when you back out transfer receipts and government stimulus payments and things like that. You see the trend line here, the line of best fit. Personal income, even though it's slowing, it remains positive, and so you rarely have a recession when you have personal income that is this strong. Right-hand side, you've got personal savings as a percent of disposable personal income. We know the savings rate has gone down, and I think some might look at this and suggest that we're going to have lower spending. I think that's probably a reasonable bet. If we had higher savings rates, I'd say that the consumer had more dry powder to spend from. Looking at this chart, it's clear that they certainly don't. And so I do think, while personal income is continuing to move in an upward trajectory, even though it's slowing a bit, you're seeing personal savings go down, which I think is going to impact our consumer spending a little bit in the months ahead. Here's the Atlanta Fed. And so the big buzz this last week is that they came out and basically, revised their forecast. And so the Atlanta Fed has they call a GDP now estimate of second quarter growth, and they're now estimating -1% growth. And so that was a revision down from a positive outlook earlier in their prior reading. And the consensus is very, I'd say it's mixed right now. You can find as many forecasters that are expecting slightly positive growth as you can those that are now predicting negative growth. But not that I'm going to say that the Fed is the end-all be-all for predictive capability. It's just clear that the data that they're looking at suggests a negative GDP print for the second quarter. And if that is the case, even though it's not a technical recession as it's defined by the National Bureau of Economic Research, or NBER, it is, 2 negative quarters of economic growth are typically associated with a recessionary environment. And so oddly enough, despite the fact that we have really tight and strong labor markets, and we have really high relative real personal income, I think there's about a 30% chance that we may be in a recession right now, and just not really realize it. But again, unusual circumstances. But here is just essentially one key forecaster that's predicting negative growth in the economy for the second quarter. Here's the manufacturing surveys from both the Dallas Fed as well as the Philly Fed. You can see both are directionally moving in the same way and really tell the same thing. So when you look at manufacturing, you see both of those are rolling past that 50 level, which, these are diffusion indices. So anything below 50 represents contraction. And so, as I mentioned a few minutes ago, I think that if we're not in a manufacturing recession, I'd say we're very close. Here's consumer confidence, and I also included the Gallup poll recently. So this is the Gallup's Economic Confidence Index, and this is an individual survey that they do, and so I think the more formal consumer confidence number that we cite every month is also relevant here. It tends to be a little bit more smoothed out than we see from the Gallup poll. It may have issues to do with sample size, so on and so forth, but both are moving down. In fact, the consumer confidence indicator, amidst the backdrop of inflation, continues to roll over. We see in the Gallup poll, we're at levels we haven't seen since 2008. So consumer and economic confidence, essentially consumer confidence, is fairly low right now, which actually can have some very contrarian benefits. Here's our personal consumption expenditures PCE deflator year over year on the left-hand side. It actually came in a little bit less than expected. You can see we're not quite at peaks, although we're still at relatively high levels. And then the core PCE deflator clearly was below the survey estimate and is clearly rolling over. Now, this is not, I think, the Bible necessarily of what we should be watching for inflation, but it's what the Fed pays attention to. And so when you look at price deflators and they are rolling over, this is what we want to see, right? We want, we've got demand slowing. We also have inflation expectations slowing. And in the May survey, at least for inflation at the PCE level, we're clearly seeing inflation coming down. Here's our PCE deflator for housing. This is one area that, however, is moving up, and we'll see. We've got some housing data here Clearly, housing is getting more expensive, even though rates are moving higher. We see mortgage applications going down and essentially refinancings going to zero for the time being. But, we do have housing that's continuing to move higher. Here's our inflation expectations, and again, we've got the 5-year on the inset here. This is a Bloomberg chart. You can see, as we've talked about, that the 5-year inflation estimates 5 years from now are coming down, and we see that here on the broader chart where you've got the TIPS 5-year break even. So this is just kind of re-emphasize this point that inflation expectations are coming down. Here's our inflation bias that comes to us from Capital Spectator. And again, you can see that these levels are coming down off of their peaks. Now here's a quick chart from Bloomberg that caught my attention. And you look at the UK, Eurozone, and the US. What are the components of inflation? What was interesting in this analysis, and I think this came from a tweet by Lisa Abramowicz at Bloomberg, but her thesis here is that the red has more of the red area, which represents services, as a component of inflation, and service inflation tends to be stickier. And so her contention is that we're going to see the Fed act more boldly and act longer than will be the case likely in the Eurozone and the UK. And if that is the case, then you can make the argument that dollar strengthening is likely to persist for some time. Here's our CoreLogic Case-Shiller 20 City Composite Index, and kind of talking about real estate for a second. It's really amazing to me to see the continued upward trajectory in home prices. Now, I do think home prices will moderate. I'd say the growth rate will moderate. We probably won't see outright declines, but this just speaks to the power of the decade or so of underbuilding that we have done amidst this rash of increased demand and household formation. New home buyers are extremely frustrated that they can't find affordable housing for them at their lower income levels, and it's just something we're going to have to monitor, and housing is clearly a choke point. And it's not just a profit motive on the part of builders. I mean, obviously input costs are higher, even though commodities are coming down. So here's home price to disposable income ratio. And again, speaking to the point that I just made about affordability, we have never seen a level like this going back many decades. I mean, just think about it. Home sales price divided by disposable income. And so this just tells you that we're in stratospheric zone right now. Monthly rents continue to move up. They're up at a 14% year-over-year clip. This is national. And so rents typically take about 9 to 12 months to catch up with home prices. And I can tell you that indeed they have. Now let's talk about commodities for a few minutes. We had some of these charts in the pack last week. Commodities are rolling over. Industrial commodities, ag commodities, in a lot of different areas. Obviously, we're not seeing the softness necessarily in like the energy related commodities. But you can see here, I mean, you've got the Bloomberg Commodity Index that continues to drive lower, and particularly impacting the commodity sensitive stocks, which are in the lighter color. Here's industrial metals moving lower. We clearly see that. This is the divergence that I mentioned between industrial metals and energy. So obviously energy continues to remain high, even though it's come off its peak. But we see industrial metals, and you can see that kind of highlighted by both aluminum and copper on the right-hand side. Both charts look very similar in the magnitude in which we've seen the drop. Now they're not back down to pre-pandemic levels by any stretch, and prices remain high, but they're certainly well off their multi-month peaks. Here we look at winter wheat, which we were expecting to be high once we knew Russia was invading Ukraine. Global producers of wheat, particularly in that area, account for probably 20% of the global bread basket, if you will, and so prices spiked then. But we've seen those prices come off quite a bit. Again, not to what I'll call pre-war levels, but they've come off their peaks quite a bit. Corn, same thing. Again, not down to pre-war peaks, but they've certainly made a bit of a round trip lately. Here's crude oil production. Now, we've talked about crude oil prices remaining on the higher side, but I think what's kind of lost in this discussion, of course, there's a lot of squabbling between the federal government, particularly the Biden White House, and oil producers about windfall profits and things like that. When you look at oil production, I mean, a lot of it is captured by independents, frankly. In addition to Shell, BP, and Exxon and the majors. But you have a lot of production increases as of late, and that's continuing to move higher. So there is a response to this. Although if you look at on the right-hand side, I thought this was very interesting. It's from the Daily Shot. Drilled but uncompleted well counts are really, really low right now. And so, what that means is that you're going to have more investment. You're going to have people begin to commit risk capital to see continued increases in production that would help drive that line on the left-hand side of the chart meaningfully higher. Here is the daily national average gasoline price indicator, and what's really interesting here is that in the last 3 readings, we've actually had some drops in gasoline prices, and there was a lot of speculation even 30 days ago that we were going to see $5.50, $6 gasoline, and that's a level that I would absolutely expect to see much more meaningful demand erosion. But frankly, we haven't seen it yet. Prices around $5 a gallon nationally, but they have come down in the last few data points. Now here's corporate profits. We know they're coming down. This is essentially a chart that kind of tells us that. So, I mean, corporate profits can kind of jockey around a bit. And this data set goes back all the way to 1980. But you can see here that, I think it's very healthy. I think if we were sitting here and profits were still abnormally high, I would really begin to worry about an earnings reset, because from the equity market standpoint, the biggest risk now is that you have profits erode a lot faster than people expect, because then that makes the market inherently more expensive from a price to earnings standpoint. And so we want to monitor this piece of it pretty tightly, but it's really good to see here that we've already had profits back off a bit, and that's led to expectations being priced into the market. So I'm going to end here on this slide, and this is a chart that I think it tells me one thing in particular, and that is that we are going to be dependent on carbon-based energy sources for quite some time. This is global, so it's not, obviously, the different strokes for different folks, and different looking chart if you look at different geographies and different countries, but overall this world is going to be highly dependent on carbon for the foreseeable future for its energy generation. Lots been made over the green energy transition, and the regulatory push to drive green energy. At the same time, you've got production shut-ins on the carbon side. We're getting away from coal, and then we're not investing and reinvesting into some of our carbon-based production schemes here in the U.S. So, and that's a real thing, right? And so it puts us in greater jeopardy from an energy or from an electricity capacity standpoint. That we're making this transition to green energy almost too quickly. We have not planned for this transition very well. But clearly, the carbon-based sources are not going away anytime soon. Well, that will do it for the chart pack this week. Hope you've enjoyed that. Please feel free to reach out at the information you see on your screen. If you have any questions, we'd love to hear from you. Have a great week. We'll talk to you again soon.